Hello, today we're going to talk about the bond market, which is the financial instrument most used in the world. And I want you to think about bonds only as a note of credit. So it's a regular note of credit, just as if you go and ask for a credit in the bank and you promise them to pay back the money, they're going to charge you with some interest. But only in this case, companies and governments are the ones that issue this type of instruments. Okay? When you hear or read the word issuing or issuer, that means the entity that is creating the bond and selling the bond to the market, therefore obtaining money in exchange. And they promise to pay some interests to the people, to the investors. Okay, in the case of the government, which is this presentation about, the government promises to pay interest to banks, and the banks then redistribute these bonds to the people, to the investor public. Okay, in the case of companies, the investors are the ones that buy these bonds directly. Okay, so they are not easy to understand, especially when we go into the calculations of it. But this first presentation is just gonna touch about a little introduction of government bonds, which are the most popular and most important to understand. Okay, so we're gonna have two main types. We're gonna analyze corporate bonds, which are companies, and government bonds. We do have some exotic bonds in the market which combine the two, or they combine funds, or they track different currencies. But we're not gonna get into that. If we have time, I'm gonna post a very interesting article about those. But the main ones in the market, in the international market, are corporate and government. Okay. So the government is just, the formal definition is just a debt security, and as I said, it is issued by the government of a country. Now, why would a government issue money? Well, we talked about this a little bit at the beginning in the introduction of the markets, and we talk about government spending, right? So when the government spends more than what they receive from taxes, they have a deficit. So they need to get that money somewhere, from somewhere. And that money can come from bonds. They can issue a bond to the banks, and the banks pay that money. And again, I'm gonna be a little bit repetitive here. The government in exchange promises the payment of some interests. Okay? Now, it is very interesting to note that government bonds are considered risk-free bonds, zero risk, which means that the default risk associated with this instrument is almost zero. It doesn't exist. In other words, all the government bonds issued by these these countries, they are backed up by these countries. So they will, quote unquote, they will always pay the interests. That's why it's considered default rate zero. Now, this is interesting because there has been some stories or cases in the world, like Greece, where they haven't paid the interest. They haven't fulfilled that promise. So technically, they cannot be considered risk zero, free risk, because there's a risk associated with the country. And if the country goes bankrupt, then they won't pay the bondholders. And bondholders is another word that you're going to hear a lot over this module and any readings you do about bonds. And it's just the investors, the banks, and the people that own these bonds, okay, that buy these bonds, okay. Now, another interesting fact about government bonds is because they are considered the minimum or risk zero, This is the benchmark for all other bonds as far as interest rate. As you know, interest rate is made by a time component and a risk component. The longer the time, the longer the cost of opportunity for your money, so the higher the rate should be. And the greater the risk, the higher the risk should be too, and the higher the rate. So if, for example, a Banxico Bonde bond is marked at 5%, then in Mexico, that would be considered the lower interest rate, and then the other government bonds and corporate bonds will start from there all the way up. Okay? Now, the risk, the interest rate, is obviously associated with the returns. So if this is considered the lowest risk in the market in a country, then they're going to have the lowest returns. So these government bonds, especially the long-term bonds, are good for investors and banks and types of investment that are looking for a long-term return. Okay, these are not good instruments for investors that want to make profit quickly. Okay, so these are the lowest rates, the lowest returns, were also the safest, in summary. Okay, how do they control this money supply? This is the most important part of it. Okay, the governments choose to either sell or buy bonds according to their monetary supply and according to their strategies as far as what they want to do with the amount of money it's available in the market. Okay, so this is simple and this is straightforward. If the government wants to repurchase some of the bonds or even buy corporate bonds that are available in the financial market, they will have to pay money for those bonds, which means they will increase the money supply in the market, in the banks. So the banks will have more money available, less bonds and more money, and they will have to do something with that money. They will have to lend that money to individual investors or just regular customers, right? So that this means that the credits or the credit market will expand, interest rates will tend to go down, okay? Credits will tend to go cheaper because there's more money available in the market. So whenever the government sees that the economy is not doing well and that people does not have money or businesses are not growing, they will start repurchasing bonds and injecting money in the financial system. Okay? The opposite action would be to sell more bonds, therefore restricting the money supply there's in the market. So whenever they sell bonds, the banks are now sending the money, the cash, to the government. Okay, and the government can hold it as long as they want, and that's a restricted policy. They do that, countries do that, when they see inflation and prices going up, or when they see the economy overheating, overgrowing so fast. Now, why is this important? You might think, well, if the economy grows and grows and grows, that only can be good. Here's the problem. When the prices start going up and up and up, the majority of the money goes to the owners of the companies, not to the workers of the company. So when inflation grows, people working do not receive different paychecks, different salaries. So their money every day is worth less money. Okay, the majority of the profits is controlled and held by the owners of the companies. So that is not good for the country because the majority of the people starts to suffer as far as value for the money. So the government will intervene and sell more bonds, restrict the amount of money, and make credits more expensive because money is not available. So credits will go up, interest rates will go up, and they will uh, try to control that inflation and put that inflation rates down again. Okay? In other words, they repurchase bonds to put the interest rates down, to put more money and interest rates down. And they sell bonds to put interest rates up. Another way of seeing this is whenever they see inflation rates going down, they will repurchase the bonds, putting more money and trying to pick up that inflation rate. Or if they see inflation going up, they will be selling bonds and trying to control inflation and put it down. Okay, so governments are always doing this. They're always buying, selling, trying to mediate the market, okay, and balance the market. Let's look at some of the most important treasury bonds that the US government has. You can see different periods in here. I'm gonna post a couple of links where you can go and see the actual bonds, how they're performing, and you will understand this information better once we finish with bond pricing and you understand how they price and how these yield rates move. But for now, just see there are different maturities from 3 months to 30 years. Some of them pay coupons, some of them have a yield rate of about 2%, some of them over 3%. And this is the most famous or the most active treasury bonds of the US. This is the types of bonds that our country has and trades. Okay, they all serve different purposes. You know, CETES, bondes, UDI bonos are the ones that protect us against inflation. So the UDI, the Unidad de Inversión, was invented to track the inflation rate, and it will go up or down according to the inflation rate. So whenever you sell the bond, you will just exchange it for the number of UDIs to real money, and that way you will not be affected by the inflation swings and volatility. Okay? Again, I'm gonna post a couple of links and you will be able to see how these bonds behave and how many bonds are in the market, etc. Okay? The UK also have, these are also very important bonds because these are the main bonds in Europe. You can for now compare the yield rates. These yield rates are lower than the US. This is information for from this week, so it's pretty actual and current. Yield rates are a little bit lower in the UK than they are in the US, and of course in Mexico they are higher. Japanese bonds, they even have negative rates, and I'm gonna talk about later on once we understand again pricing. But these are the lowest bonds in the market right now. Okay, the country does not have inflation, and they don't have to put interest rates up because they don't. The economy is not in a fast pace, so they are not worried about that. Okay, so for now, that's all about bonds. We're gonna see later on how we can calculate the prices. Okay, great to talk